So good morning, everybody. Once again, we're now starting the fourth session with academic papers. And before we start, I'd just like to thank the organizers for making this great choice of papers. We have had lively discussions, and I hope very much that we will have lively discussions in this session as well. So the topic of this fourth academic session is non-banks. The first paper will be presented by Franklin Allen. It's Monetary Innovation and Financial Architecture, which is co-authored with Ansgar, Walther, and Franklin. We're looking forward.
Thank you. So I'd like to thank the organizers for inviting me. I used to spend a lot of time in Frankfurt, but I haven't been here for some time, and it's very nice to be back again. So today there are over 24,000 cryptocurrencies. Many of them are not in active use, but quite a few still are. It's difficult to measure exactly how much they're worth, but my colleagues in computer science tell me it's about $4 trillion worth. So just to give you a rough idea of the equivalence of that, it's like having the auto industry. It's the same amount of wealth that it's created. Bitcoin is obviously the most famous. I checked it yesterday. It was trading at just over $100,000. That's down from the max, which is around $125,000, but obviously it's still very valuable. It was originally designed as a means of payment, but because of its volatility, it didn't serve that purpose very well. Now, when the proposed Libra was designed and talked about as being a way of having a stable coin where you could have the advantages of Bitcoin, in other words, quick execution and things like that, there was a lot of interest in that. And there were early problems with ones which were actually implemented, and a number blew up. And I think it's important to remember that probably a zero interest time was not a good time to try stable coins, because people took risks because that was the only way they could make money from it. And so today, because you can't pay interest on stable coins, they're a money machine. You can invest it on treasuries and get large return. And now, today, Tether is over $100 billion of transactions a day. So it's small relative to the total, but significant. Now, initially, central banks were very skeptical about the role of crypto. But as the world evolved, it's become more and more attractive, and many countries are now seriously considering CBDCs. There are three that have them actually in full operation. So the first was the Bahamas with the sand dollars, the second was Jamaica, and the third is Nigeria. Now, having said that, I think the country which probably has the most advanced in some way is China with the e-yuan. So the original idea was that for the 2022 Beijing Olympics, they'd have a fully active CBDC. It didn't work out that way because of COVID, so they had the pilots, they did those things and went through with that stage. And in some sense it is in operation domestically. I think today that the biggest important role of the yuan is cross-border. Domestically, it's very difficult for them to compete with Alipay and WeChat Pay. Those are such efficient domestic payment systems that the yuan doesn't compete. But now with the mBridge initiative, the yuan is beginning to be used for oil transactions with the Middle East. And if we do have an increase in political tensions, I'm sure they're ready to scale up and start using it in large quantities. Now, this is an area where the US is going in a different direction than Europe and the rest of the world. So Trump, one of the first things he did was to ban the research of CBDCs in the Federal Reserve System, as I understand it, and in the Treasury, and in other government agencies. So last week, of course, the ECB announced that they're going to have a pilot of the euro starting in 2027, and then the notion is that there'll be full implementation by 2029. Now, so what we are interested in this paper is, first of all, we've got these significant changes in the way that money works. We've got this public innovation of CBDCs. It competes with bank deposits potentially, and you can think about this as having retail deposit at the central bank as being the extreme form of it. And then in private innovations, we've got stable coins and various other payment mechanisms, which are in different parts of the world increasingly efficient. Now, at the same time as that, we've got a significant change in the financial architecture. So it used to be that the classic example of a non-bank was GE Credit. GE Credit had the feature that instead of raising money with deposits, it raised it in capital markets. And that meant it was a non-bank, but otherwise it lent money very much like other banks. So GE Capital was a very important forerunner. But with the breakup of GE, it doesn't exist in the form it used to. Nevertheless, non-banks have continued to increase their importance, and at least by some measures, they now constitute about half or more of lending in the US. There are large differences in the stability of in the leverage and stability between banks and non-banks. So non-banks don't use as much debt. They have much larger equity. And their debt is much less concentrated. It's much more concentrated than deposits. Now, I think one of the important issues here is the fact that the banks have developed a strong lobbying effort in pretty much every country. And so they are subsidized to a degree that non-banks aren't. So they have bailouts, they have subsidized deposit insurance, and many other forms of subsidy. And so we're going to take that as given. You might just say to what I'm going to argue, the model I'm going to develop, well, why don't you just change it and get rid of all the advantages, the political advantages that banks have? But Anat and Martin Hellwig can explain why that doesn't work very well. So what we're going to do is develop a model which takes account of this non-bank issue. And let me just run through very quickly this findings of Zhang et al. Of the non-bank system. So non-banks have substantially more equity capital, so lower leverage than banks, but less than non-financial firms. Leverage across non-banks is substantially more dispersed than leverage across banks. So banks tend to go to the limit, whereas non-banks seem to make a more structured, capital structure decision. Non-banks finance themselves primarily with short-term loans, and they originate long-term loans. So in many ways, they're very similar to banks. As I said, their debt is much more concentrated than banks' debts. Non-bank capitalization decreases substantially with size. So the bigger they get, the more one could interpret this as being that they're likely to be bailed out, that they may not have a formal guarantee, but if things go wrong and you're a very large lender, then the market seems to think that the government may well come and bail you out. And consistent with our average interest rates on uninsured debt decline with size for banks and non-banks. And non-banks pay substantially higher rates than banks on debt. So what we're going to do is to develop a model of these kinds of things. So this is going to be a model with a number of margins. We're going to have banks that choose their capital structure, and similarly for non-banks. Both of them are going to compete in a market for investments, or in other words, for loans. And what we're going to have is them making decisions and deciding things endogenously. So it's quite a complicated model. I'm not going to go through all the details, but I'm hoping I'm going to give you some of the basic machinery that you'll need to understand some of the results that we're going to look at. And the basic question we're going to look at is what's the difference between private money creation, so stablecoin kinds of things, and CBDCs or public money creation. So we're going to use B for banks and N for non-banks. They're going to issue debt to households, and they're going to compete for these risky investments or loans effectively. Later, we can relax that. Households fund the banks and non-banks only with debt investments. So we're not going to have an equity market explicitly there. What we're going to assume is that the intermediaries, or the people that own the intermediaries, can provide the equity capital that they need. Now, we're going to assume that banks have various advantages, one of which is that they may be bailed out, so that you know if you're going to invest in a bank, it's not going to default, that it's going to be bailed out. We're going to have various types of monetary services. So this is going to be very much in line with the convenience yield view of the world, which has come back in recent years. So the Krishnamurti and Jorgensen's kind of view of the world. So we're going to take money as being something in the utility function. So utility of the household, the equation at the bottom is going to be your consumption today, and there's only one date up in the future, and that's going to be your expected consumption. So everybody's risk neutral here. We don't have any risk aversion. And then there's this third term, which is your money in the utility function. And the M bar is the aggregate monetary services that are provided by the various types of payment systems you have. So you can think of this as being, you have a bank account, and there are a number of ways you can make payments. You can do it directly with a debit card, or you can write in the US checks, or you can have a credit card and you can pay that monthly and so on. These all have different amounts of convenience, and this is represented by the thetas in the equation. So theta b times mb that's what banks give you. Theta b is this quality that they provide of monetary service. MB is the quantity. Theta n is the non-banks. Mn is the quantity of that. And then theta c and mc are the base money that is provided by the central bank. The theta b is greater than theta n, so banks have these advantages compared to non-banks. So the novelty of this, as I indicated, is we've got endogenous leverage, we've got endogenous relative sizes of banks and non-banks, we've got public and private money supply, and the formal details are in the paper. So the first thing is that the intermediaries, so the banks and the non-banks, choose their capital structure to trade off in the usual sort of corporate finance way. So we've got cost of equity issue and distress costs and so on. And then they take into account if they're banks, bailouts, and other things, and so on. So what you can see is that if you're a bank, so we start with the blue line, and you have high convenience yield, so your money that you're effectively creating is very convenient, then you can charge a lot for that, and the bank is worth a significant amount. And because you have this ability for your debt to be good and have a high yield, you have a lot of it, so they have a larger size. If you have less convenience yield, so this is the red line, you have less debt, but you're still valuable. If you're a non-bank, you don't have such good opportunities, and so it's the black line, and you end up being less valuable and having lower value, lower debt. So if we think about what's the equilibrium look like in the money markets, what you can show is that there's an upward sloping supply curve, that's the red curve, and a downward sloping demand curve. Okay, so the vertical line is lambda, which is the monetary premium, and the horizontal is the amount of money that's out there. And ultimately what happens in this model is that the public supply of money, the theta C MC, determines the equilibrium money premium. So if we have a public monetary innovation, so something like a CBDC, then effectively what happens is that we have a move to the right of the money supply curve, and it moves down the money demand curve, so we have lower money premium, and in some sense the monetary system is working more efficiently. So there are a number of positive effects of that in terms of you have lower distress possibilities and so on, because what's happening is that their banks are using less debt and are shrinking relative to non-banks. So we've got this endogenous financial architecture structure. Private monetary innovation, as we'll see, is somewhat more complicated in that it can go both ways. You can get a similar effect as we just saw with the public money creation, but it can also go the other way, and we'll talk about this more in a minute when we look at an example. And so initially you can have an increase in the monetary premium and the welfare effects going in the opposite direction. So in terms of welfare effects, if we increase the monetary effectiveness of these payment systems and so forth, there are two effects on welfare. So the first is the Friedman effect. So generally, if you increase the amount of money, it makes people better off because they have more liquidity and so on. And that's what happens here too. There's also a bailout effect, because if you have more money and so on, welfare increases if banks leverage or market shares decrease. Now, I'm going to not go through the example in detail, but let me just say that this is a rough numerical illustration, and it's roughly calibrated to the US. Now, what we've got here is the effect of some public monetary innovations. And let me just explain what's going on here. So what we've done here is, if you've look on the horizontal axis, we've got the lambda, which is the monetary services provided by the banks and the non-banks. Now, what happens is, in terms of lending, so loans and investment and so on, if you look at non-banks in the top left-hand corner, what you can see is that we calibrated, so at 1%, which is about the kind of number that Krishnamurti and Vissing-Jorgensen get for convenience yields, we've calibrated so that the non-banks are about 60%. If you take that down to 0, they go up to about 70%. Banks, which are the blue line, go from 40 to 30 in that period. So that's one of the big changes that's happening in this model as you do various innovations. And as I say, this is a public monetary innovation, so something like a CBDC. If you look at what happens to banks and non-banks' equity assets to equity ratio, so it's the inverse of the equity amount. So what you can see here is that the leverage ratio on the top right-hand corner of banks is about 9. So it's about an 11% equity ratio. As you increase that, you run down the lambda, the monetary services premium, then the leverage ratio goes down and the equity goes up. Here we've got non-banks as stationary with that. In terms of probability of distress, that's the bottom left-hand corner, what happens is that the banks have more equity as lambda goes down, and so their probability of distress goes down. If we look at the expected fiscal cost of the given bank distress, then you can see that goes down. As banks start having more equity, they default less and cost the public much less. Now, in terms of private monetary innovations, what you can see here is that if you start out with an initial bank share of about 40%, then the private monetary innovations are always good. They reduce the monetary premium, and that's the left-hand graph. The case where you get things going both ways is where you start with banks having the high share initially. So at 100%, as you have a private monetary innovation, so the theta n is going up. Initially, the total effective supply of money goes down, and you get an increase in the price of monetary service. So it goes up, and then eventually, once it gets roughly the same as bank, then we go down, and so we then go downwards to that. So private monetary innovations have different welfare effects than public ones. Public ones are always good, private ones can be less good. So what we have here is very much a general equilibrium model where we take account of the effective allocation of resources across the economy, with the financial sector playing a primary role. It's very simplified, obviously, but what that means is it's fairly tractable. What you can see is that the effects of monetary innovation, which seem to be so pervasive at the moment, are significant, and they're significant in two ways. They not only effectively change what's happening directly through money, but they also change the financial architecture in terms of changing the balance between banks and non-banks. I think one of the most important roles of the model is as guidance for empirical work. So if one takes these changes in the world that we see as being important, then we can't take the financial structure as fixed. We need to understand where we are in it, Does it make sense to have private innovations only? Does it make sense to have public innovations only, or do we want a mixture of the two? And for that, I think we need detailed empirical work, and this model provides at least one way of starting to think about that. So let me stop there. Thank you.
Super, then we go on to the discussion. Adrien Daverna. Thank you.
Thank you. Thank you very much to the organizer of this conference. It's a real privilege to be here and to be discussing a paper of Franklin Allen. All right, so there's an active research agenda on understanding the architecture of the financial system. This agenda generally focuses on understanding how regulation and central bank intervention can both maybe strengthen and potentially fragilize the system. This paper focuses on how monetary innovation impacts the financial system. The big trade-off that they're going to study is financial stability versus the provision of money-like assets, whether it is by regulated banks, the central bank, or unregulated non-banks. There's a very big, important result here that public monetary innovation always increase financial stability and welfare. Right, so before I start by giving my comment, I would like to put the paper a little bit into context and maybe argue along the way that what Franklin calls public monetary innovation is very much related to everything that we have discussed in this conference. So we have observed a lot of changes in the architecture of the financial system. You have seen this picture ad nauseum. We have much more reserve than we used to have. This has important consequences for liquidity market. The Fed funds market becomes mostly irrelevant as traditional banks becomes completely satiated with reserve. In a sense, this development of the central bank balance sheet has pushed liquidity tension outside of the interbank market and into the shadow banking sector. So this is the price of liquidity and money now in the current architecture of the financial system. What I'm plotting here is the repo IRR spread, so the interest rate on a three-party repo minus the interest on reserve. When you see this picture, the first question you should ask yourself is, why in a system completely flushed with liquidity, with more than 4 trillion, with much more reserve, why do we see so much fluctuation and movement in the price of that liquidity? So there's two important regulations that shapes how the system is nowadays. First, you have balance sheet cost, so leverage ratio regulation that curbs liquidity intermediation and allow the spread to be negative. Remember, when the spread is negative, what a bank could simply do is fund itself in the repo market and invest that in reserve and make an arbitrage. They cannot do this because balance sheet space is very costly for them, and so this intermediation is not economical, and this is what allows this spread to be negative at times. Now, you also see that these spreads tend to spike at some times and become positive. So again, this should be an arbitrage for traditional bank that could swap just its reserve to lend into repo market. And so another piece of important regulation in the current, that shapes the architecture of the current system is this intraday liquidity regulation that constrains very much the lending of traditional bank in repo. And so I would like to argue that maybe the repo market, where when the spread fluctuates between the two bonds here, and hedge fund and dealers then lend to money market funds and firms and ultimately household, is a form of non-bank monetary innovation where the non-bank system is providing a lot of that liquidity. Now, when the floor set by the central bank is binding, we have the reverse repo facility that becomes active. John had a much better picture, more up-to-date, where we see the uptick during the whole COVID crisis. And this could be thought, I think, in the lens of the model as a public monetary innovation where the central bank is now directly providing liquidity to money market funds and ultimately households. All right, so now we have another consequence of the leverage ratio regulation where balance sheet space become very costly is that treasuries are now not held by traditional banks, they're held by shadow banks in our system. The primes at hedge fund face much more fragile funding sources. They do not have access to deposit. In that space, when you observe a dash for cash, as for example the COVID shock, these hedge funds are going to offload all of these treasuries. The yield on treasury spikes, and treasury lose their safe asset status. And so in that sense, some non-bank monetary innovation, when non-bank are in charge of doing a lot of the liquidity, provision of liquidity, can amplify the fragility of the system itself. All right, so I hope that I convince you that given there's massive change in the architecture of the financial system, this is a very timely paper. As we see, the architecture is often evolving faster than our frameworks, and so we need a lot more framework thinking about these issues. The paper in a nutshell, you have banks and non-banks that both issue money-like liabilities with a trade-off cheap financing versus default risk. One first big result is that public monetary innovation always improves welfare. The mechanism is very simple. When the central bank provides liquidity directly to households, it competes with deposit, it lowers the convenience yields. So that means that banks that trade off credit risk versus the convenience yield of issuing cheap deposit needs to cut leverage to reduce default risk because the benefit of that intermediation is lower. The second result is that private monetary innovation has ambiguous effect. When these services are provided by non-banks, you have an improvement of monetary services that will increase welfare, but you have important reallocation effect that might be negative and create an ambiguous effect in the end. The paper then does important welfare analysis, where they're going to trade off the Friedman rule, so how close we are to completely satiate the system with liquidity versus the probability of bailout and the increase in potential systemic risk in the system. Right, so my comment is mostly going to focus on the following. Franklin makes very important and strong normative claims about public and private monetary innovation. I would like to argue that it requires very strong credibility. In a sense, it must align with empirical evidence. I think it needs to also align with all the policy concern and policy debates. And you cannot have first-order missing pieces if you want these normative claims to be taken seriously by policymakers. Now, I would like to highlight the only reason why I'm able to make this comment in the first place is because of how ambitious the paper question is in the first place. Okay, so I think if we take the framework very seriously, the first best in this system is that the central bank would provide all monetary services, and we would have no non-bank sector. And this is because in the current framework, there is no cost basically to an expanded central bank balance sheet. I think as we have seen yesterday during the discussion, the different keynotes, this is core to current policy debates. One way to address this is to pick one of the following, where you think that a large balance sheet crowds out a private market. You can think about the fiscal cost of a very large balance sheet and the threat that it causes to political independence when you have an important footprint on financial market. And so here I'm arguing that modeling the cost of central bank intervention is necessary in order to capture this first-order policy concern and directly address the question that we are asking ourselves about how to best design the financial architecture of the system. There's also, in the current framework, no endogenous reason for non-bank to exist in the first place. If you would allow households to decide whether they want to create a non-bank or create a bank, they would always decide to create a bank. And this is because, you have a small technicality that we can discuss later, but non-banks are worse at providing monetary services and do not benefit from government guarantees. Obviously, this is counterfactual. We see a strong rise of the non-bank sector, and this caveat risks to provide very mechanical benefit to decrease the non-bank sector in the current framework. And so here I would argue that we need an endogenous banking sector in the framework in order to capture these forces, these important forces that shape the architecture, the current architecture of the financial sector. Two other missing pieces. The authors assume that regulatory constraint always lack. So they have a short discussion about this, and they justify this with the work of Begoneau et al., the Q theory of banks, where in that paper they showed that the book measure really binds with the regulatory requirement. But I would argue that this is because banks have large buffer in order to make sense that the regulatory measure are never binding, right? In a sense, the regulatory constraint, so SLR, is so binding for banks that banks are gonna do everything they can to never have even the chance of breaching this regulatory constraint. There's also a very large literature that documents the impact of binding regulation. I'm just citing here one working paper from the ECB, but there's many more. And so this is really important for the result and the mechanism of the paper, because leverage dynamics in the paper really drive a lot of the forces, drive the stability and the welfare terms, right? So if leverage constraint would always be binding, you have no change in credit risk or leverage for banks. In a sense, the policy prescription of the current framework is if there was no binding regulatory constraint, you should then introduce a binding leverage regulation in order to reduce credit risk and systemic risk in the framework. Another piece that I think is missing is that currently non-banks are considered to be non-systemic in the sense that they would never benefit from potential bailouts. I think that we would not have this conference if we didn't thought that non-banks liquidity provision was non-systemic. 2008 could be seen as a run on prime money market funds. You have obviously the treasury repo market risk versus via backstop, but maybe that's not the word I should use. Okay. Now here's my vision of maybe the next version of the framework. I would have equity being expensive and an explicit asset that household can invest in. Not only intermediaries, wealth could invest in equity. And it is very expensive because it does not benefit for the convenience yield. So a bank finds the leverage ratio very costly because it has access of another cheap financing sources. And when it's forced to issue equity, it needs to pay a much higher interest rate. In that framework where equity is very expensive because it does not benefit from the convenience yield, the leverage ratio regulation would always be binding. And one consequence is that an over-tight regulation in that context can choke liquidity creation. I would have non-banks to be systemic, and so maybe benefit from bailout in expectation. And that the reason that they exist is because regulation is always binding for banks, and so non-banks benefit from regulatory arbitrage. Now the downside of non-banks is that they are less safe and maybe provide much less convenience debt. In that setup, tighter rule would actually drive and shape the architecture of the financial sector and incentivize more fragile non-bank intermediation because of that regulatory arbitrage. And so finally, maybe I would shift the focus away from credit risk, just because when we talk about money, generally we have in mind financial liabilities that are not prone to credit risk, right? Can you really have significantly risky debt be a liquid asset? In a sense, stablecoin issuers are fully collateralized, the ones that are not already collapsed and not there to be here. And the largest non-bank market for liquidity is the treasury repo market, which is secured. And so the question I have maybe for Franklin is, in that different setting, I'm very curious to know then what is the impact of public versus private monetary innovation with binding regulation and collateral. And I could not answer the question myself, so that shows that maybe there is a reason for writing that paper. I would also argue that if you want to make very strong normative statement, the quantification of the different forces in your model become extremely important. And so I would encourage you to be very serious about the calibration and the estimation exercise. And I think that you actually have a lot of moments that have been uncovered in the literature that you can use. What I envision is basically a model that would be able to account for the change in the architecture of the financial system that we have seen over the last 15 years as a proof of concept that the model is able to take into account the key forces that shape the architecture and can then make prediction about what would happen with monetary innovations. So matching this moment could very much quantify the model's underlying force and help you increase the credibility of the framework. All right, so in conclusion, I really enjoy reading and thinking about the paper. I think it's very timely. It's a very ambitious paper that is very much needed to think carefully about the theory of a very fast evolving system in order to make it policy relevant so that it can be used by policymakers. I would think about adding explicit costs of central bank intervention, at the endogenous emergence and role of non-banks, have binding regulatory and leverage constraint, and add a quantitative discipline and match in order to be able to match structural changes that we have observed in the financial architecture. Thank you.
Super, thank you. Great. Franklin, would you like to take a minute or two to answer
that would be
Adrian's
great.
comments?
First of all, Adrian, thank you for a wonderful discussion, very helpful indeed. So let me just make a few comments. So this is why I said at the beginning of the presentation that the political economy of banks is very important. So that's what we've got as the problem that's being solved by the non-banking system. But you're right, there are many other ways to motivate that, and we should probably not rely fully on that. But that's what we see as to why, if you look at the empirical paper that I quoted, that seems to be the explanation as to why non-banks in the US have very different kinds of leverage ratios and so on than banks do. I think this issue of whether non-banks will be bailed out. So, in fact, G Capital was bailed out in the sense that during the financial crisis, it was given a credit guarantee. So, and that's why if you look at large non-banks, they look much more like banks, because I think the assumption is that they will be bailed out, that this is something where they're systemic and the government will step in, especially if you think about what happened with Silicon Valley Bank and so on. So that's implicit. You're right that there are other ways of motivating things like equity versus debt decisions for banks and non-banks, and we'll think hard about them, because what we want is a fairly clean model. I think at the stage that we're at, we're not trying. You're right. We make too many policy claims and things. This is a very simple way of thinking about things with not a lot of real-world details, which I think ultimately one would need to make the decision which is being made. Should we have a CBDC or should we rely on stable coins? That's a very complicated decision with lots of implications. One of the things that's missing from our model, which I think is very important, is public institutions, by and large, don't make good innovation decisions. So I think the US payment system is an example of that. It doesn't work very well. It hasn't evolved in a good way in the way that it has in Europe, for example. It's still very much like it was many years ago, although it's updated in terms of now instead of shipping the checks around physically you have electronic images of them and so on. So I think that's another important thing. And what the private sector is really good at is innovating. And the whole cryptocurrency story is a good example of that, because it came out of nowhere and worked that way. But certainly, please send me the slide. We'll think very carefully about the points you raised. Thank you.
Thank you, private sector. That's one of the clue words here. We open up for questions. Do you have any questions or comments? Let's start there in the back, please.
Thanks a lot for the interesting presentation. Ben Hartung, ECB, working in market operations. I had a bit similar questions actually to the very good comment that you received on basically the dynamics between banks, non-banks, and the central bank providing monetary innovation. And I think what I was also missing a bit was the understanding where essentially the trade-offs lie, because at first glance I would think, okay, the best thing is if the central bank just provides this monetary innovation. Obviously in practice that's unlikely to happen. But then what I was wondering in your model, also with the caveats that you mentioned, what would happen, for instance, if the monetary innovation would not happen on the non-bank side, but on the bank side actually? So if the banks would actually come up with, for instance, stable coins or other private money that offers a benefit to payment services. Because if I understand the model correctly, then these very leveraged banks that have this bailout, say, social welfare costs to them, they would attract more market share. So that there the effect might actually be ambiguous as well. So that's one thing I was wondering. And similarly, I wasn't sure if you would have two effects at the same time. So for instance, there was a CBDC, but at the same time, there was also a non-bank alternative to that. So what would a horse race of that look like in terms of market shares and market dynamics? Thanks a lot.
So thank you. That's a very important point you make. So I think in these kinds of simple models, there are a whole lot of things being aggregated. So, I think one of the big issues is about payment systems, and then the other is how you make savings. So this is sort of very much in the Friedman-Schwartz view of the world, that the problem with the banking system is that it has the payment system embedded in it. And I think one of the things that CBDCs give is to put the payment system in the central bank so that you don't have to worry that your payment's not going to go through, there's going to be a failure. All of the things that Friedman-Schwartz kind of pointed to as being the problem in the US in the late 19th, early 20th centuries. And if you think about things that way, the notion is that you wouldn't have your account to make savings in the central bank. You'd have it to make payments, and then you'd put your savings in the capital market. So you'd put it in mutual funds and so on. So if you think about how some people run their lives today, you make your payments with credit cards, and then once a month you pay off the credit card. And that's the kind of world I think that we're thinking about here. Capital markets seem better at making investment decisions and resource allocation than banks or central banks. And I think that's ultimately what we're trying to do. And that relates to some of the questions that you asked, which is a deeper question, but it essentially evolves around how do we think about banks? And we tend to combine payment system issues with savings issues. But I think the key point is that you can do savings things through non-banks like mutual funds and things like that.
Great. Other questions? Okay, please here in front. Thank you.
Hello, so Societe Generale again. How do you see the impact of stable coins on capacity of banks to retain deposits? Because it's a means of payment, okay, but contrary to the Visa card or to any other payment transfer possibility, they need to have a segregated amount of cash to be able to function. So when you issue stablecoin, you put aside this amount of cash. So what do you think this will have an impact?
So I guess it relates to the last question, some of the other points that Adrian raised, which is, stable coins are another way of making payments. They tend to be advantageous because you get instantaneous settlement de facto. You don't have to wait T+1, T+2, or whatever the markets are doing. And I think that's an extremely important aspect of them. Now, the question of whether you actually need cash in your bank account relates to that. Would you need to hold stable coins to make payments? So as I was saying, I mean, the ideal way to do things is to have some kind of mechanism to make payments, which we now have a number of, where you don't have to have cash. And so that would be the efficient way to do it. And then you use the money to go into interest-bearing or capital gains and equity and that side of things. So quite how we innovate and how we get systems which have the advantage of settlement very quickly and payment very quickly and economize on the use of actual cash holding things in bank accounts, which effectively are how banks to a large extent fund themselves. You get zero interest, but you need to keep the cash there. There are ways to minimize that now. And as we go through and, if credit cards work differently so that you couldn't just carry a balance and then pay it off and it doesn't cost you anything, then it may well be that we have much more efficient ways in terms of handling cash. But stable coins, I think, are very important for large-scale transactions. Whether they will be for small-scale transactions, I think that's something that there's still a huge amount of opportunity for innovation. So if you look in China, things like Alipay and WeChat Pay are very different and interesting ways of dealing with those issues.
Okay, thank you.
Great, thank you very much. Everybody else was very disciplined in terms of timing, so we move on. Thank you for the questions, thank you for the presentations. So the second paper will be presented by Gabriele Laspada. It's Banks Balance Sheet Cost Monetary Policy and the ONRRP, and it's co-authored with Gara Afonso and Marco Cipriani.
Okay, so good morning, everybody. First of all, I want to thank the conference organizers for including our paper in the program. It's always a great pleasure to come to the ECB, and for what I work on, I can hardly think of a better conference than the ECB Money Market Conference. So the title has changed slightly. It's the same paper. Some of you have already seen it. It is that we believe, it's fine. We believe it's just more general than not the UX experience and the ONRRP that John has mentioned previously in his speech. Joint work with Gara Afonso, Marco Cipriani, my colleagues from the New York Fed. Usual disclaimer applies. These are our own personal views. They do not necessarily reflect the views of the Federal Reserve System or the New York Fed. So what is this paper about? So the starting observation for this paper is that monetary policy interacts with bank regulation. Okay? When I say bank regulation here, what I have in mind is all those types of regulation that introduce balance sheet costs in the banking system. So think SLR, supplementary leverage ratio, all these things that penalize balance sheet expansions financed by debt. Okay? So how does it work? Think of QE. When QE is done by purchasing assets from non-banks, what it does, it expands banks' balance sheets. Okay, injecting large amounts of these very safe, low-margin asset reserves, central bank reserves, into the banking system, and these reserves are going to be backed almost all the times by various combinations of deposits. So what it does, it tightens banks' balance sheet costs, balance sheet constraints. Now, there is a growing literature on this interaction between monetary policy and this kind of bank regulation that looks at bank behaviors, in particular bank lending. So my discussant, Himing Ma, has an excellent paper in the JFE. I encourage all of you to read it if you haven't done so yet, in which he shows that large injections of reserves crowd out bank lending. So in this paper, we take a different route, and we look at the MBFI angle. And specifically, we ask the following two questions. So first, what are the effects of this interaction between monetary policy and bank regulation on non-bank financial institutions? And here, when I talk about MBFIs, what I have in mind are those MBFIs that compete with banks in the deposit market, going a bit back to Franklin's presentation. And the second question is, if these MBFIs have access to the liability side of the central bank's balance sheet, how does this interaction affect the composition of the central bank liabilities? So why do we care about these two questions? Well, I think Franklin's presentation before just set the stage for this. Well, because answering these two questions is actually at the core of addressing the broader, bigger picture question, which is, should the central bank provide access to the liability side of its balance sheet to non-bank actors in the first place? Okay, so think about stablecoin issuers, whether they're fully private or they're asking for access to the central bank balance sheet, CBDCs, even the idea of a narrow bank. All these policy topics we're talking about, they all revolve around the same idea. And in this paper, we're trying to make a simple empirical contribution in that direction by studying how monetary policy and bank regulation interacting with each other affect MBFIs and the usage of central bank facilities. So what do we do exactly in this paper? So this paper is going to be very US-centric, apologies. The sample period that we look at is 2020-2021, so a period characterized by large injections of liquidity, so large QE operations in the response to the COVID pandemic. We are going to need some source of exogenous variations in balance sheet costs, and in particular, we're looking at the SLR. So what we're going to use is this episode that I think Jeremy mentioned also yesterday in his keynote speech, the SLR relief of 2020-2021. What happened then, basically, for 1 year, bank regulators, exempted reserves and treasuries from the calculation of the SLR, relaxing temporarily this constraint. Okay, so we're going to use that exogenous variations in banks' balance sheet costs, which is ultimately driven, however, by the large QE injections. Okay. Then MBFIs. What MBFIs are we looking at? So I said those that compete in the deposit market, and so far, until now in the US, the main competitors are money market funds. And they play an important dual role in money markets in the US because they compete with banks in terms of deposits, offering deposit-like products to depositors, but they're also the main providers of short-term liquidity to banks in the wholesale market. And both roles are going to be key. We're going to look at two aspects of money funds, so the size of the industry, and then their portfolio decisions, and in particular, the decision to invest part in their portfolios in the overnight reverse repo facility at the Fed. So this facility that we introduced back in late 2013, that is open to this important MBFI. Our results, so this is going to be an empirical paper, of course, but also an identification paper. So let's switch gears. What are we showing is that when banks' balance sheet costs go up because of these large injections of QE, of reserves due to QE, well, the money market fund industry grows. And the idea is very, very simple. If your balance sheet costs increase as a bank, you have an incentive to shed deposits, and these depositors will find a way into money market fund shares because they're the closest substitute. Fact number one. Second main result, when banks' balance sheet costs go up, they also have an incentive to reduce their wholesale short-term borrowing, and then their main providers of wholesale liquidity have to do something else with their cash. So they're going to repivot, ceteris paribus, towards the deposit facility or whatever, deposit-like facility that they have with the central bank, in our case, overnight RRP. So those are the two main facts that I would like you to take away from this. We also identify additional drivers of overnight RRP take-up or this deposit-like facility take-up open to non-banks at the Federal Reserve. And there are interest rate risk and supply of government bonds. So higher interest rate risk and lower supply of T-bills, both are going to push overnight RRP take-up up. So they're going to give NBFIs an incentive to place their cash in an overnight deposit-like facility at the central bank. Okay. So this paper is really grounded in institutional details, so you have to bear with me for a few slides because I have to go over all the institutional background. I know my boss doesn't like all this, but I have to go through it anyway. So let's start with balance sheet costs, supplementary leverage ratio. That's what we're after here. What are balance sheet costs? These are all the costs that penalize, that are proportional to the bank's balance sheet size. So they're going to penalize balance sheet expansions financed through debt. Okay. I would argue that the most important one, at least in the US, is the supplementary leverage ratio. How does it work? It was introduced by Basel III, and it's the ratio between Tier 1 capital and total assets. Okay? That needs to be greater than a given minimum requirement. So what are the key aspects of this object? Number one, the assets at the denominator are not risk-weighted. Okay? So this constraint particularly penalizes balance sheet expansions aimed at financing either very safe low-margin assets or, in particular, safe intermediation. So think of reserves and repo intermediation in the treasury market. That's key. Second thing that I'm going to use for this paper, it's very important for us, the assets of mutual funds affiliated with banks. So several banks in the US sponsor mutual funds, have affiliated mutual funds. Well, those assets are not included in this ratio, the denominator. And this is going to be key, of course. Okay, so let's talk about the relief episode. So on March 2020, again, Jeremy went over this. I don't need to spend much time. You all know that there was severe distress in money markets, in the treasury market in particular. So at one point in March 2020, actually, the Federal Reserve started injecting lots of liquidity in the system. In a month, I think, from early March to April 1st, we injected roughly $800 billion in reserves. Okay? And we kept doing it in April to reach almost $2 trillion of reserves injected in less than 2 months. Unprecedented. It kind of worked, of course, it did work, but at the same time, regulators realized that they were tightening massively the balance sheet constraints of the intermediaries, of banks in particular. So they announced a relief, temporary relief. How does it work? Reserves and treasuries were excluded from the denominator for 1 year. So the relief was announced on April 1st, 2020, became effective, at least for DIs, in June 2020, and it was set to expire at the end of March 2021. All this was announced at the beginning, so the expiration date was known to everybody at the beginning. What was the goal? By relaxing this constraint, the goal was to facilitate bank intermediation basically in the repo market, in the treasury market. I want to convince you that it actually had a material effect on banks' balance sheet cost. So here I'm plotting the time series of the SLR for the G-SIBs in the US from 2018 to the end of 2021, quarterly frequency. And first of all, so the two vertical lines represent the introduction of the relief and the end of the relief. So first of all, you see that the SLR goes down, starts trending downward in the first half of 2020 as we started injecting reserves through QE and getting closer to the minimum requirement, which is the horizontal dashed line, 5%. Then, as the relief is introduced, of course, the SLR goes up, so it's relaxed. Banks are further away from their minimum requirement. But as soon as the relief ends, following quarter, the SLR of all G-SIBs goes down back, much closer to the minimum requirement. So that's what we're going to focus on in this paper. We're going to use the end of the relief to make sure that our results are not contaminated by the money market stress of March 2020. And we're going to take the permanent shift in balance sheet cost, basically went up for all banks, as our source of exogenous variation in balance sheet cost. So the end of the relief, SLR goes down for everybody, balance sheet constraints are tighter. Okay, the MBFI part of the story, money market funds. Well, as of the end of March 2020, so roughly our sample period, at $5 trillion in assets under management. Now they have almost 8. They're clearly the largest cash lender, except for banks, in the US economy. 2 types, government funds. They can only hold government securities and repos collateralized by government debt or agency debt. And then you have prime funds. They can do all of the above, but they can also lend to the private sector through unsecured debt contracts, both financials and non-financials. So you have certificates of deposits, commercial papers, also local authorities through floating rate notes. And those is about the type, so what they can do with their portfolio. So why are they important? Because they're the main alternative to banks in the deposit market for depositors, but they're also the main providers of liquidity in the wholesale market to the banking industry. The kind of institutional thing that I'm going to use in this paper is that 30% of the money funds in the US are affiliated with bank holding companies, okay? And finally, last but not least, this deposit-like facility open to non-banks in the US, the overnight RRP. So how does it work? So it's an item in the liability side of our central bank, of our balance sheet. So through this facility, a bunch of counterparties can invest at the Federal Reserve through overnight reverse repos collateralized by treasury securities, okay? Eligible institutions, of course, banks. Then you have primary dealers, but then you also have government-sponsored enterprises, federal home loan banks that John was mentioning before, and money funds. The rate is set by the FOMC in the communication of the monetary policy stance. And why do we have it in the first place? And the idea, as John mentioned, is that you want to have a firm floor of money market rates by providing these important non-bank money market lenders that do not earn interest on reserves a fixed rate, okay? An outside option with a fixed rate. So, as I said, it's a liability on our balance sheet, which means that if we hold the size of the balance sheet constant, if this liability goes up, reserves have to go down. And the reason is that investment in the overnight RP works through the banking system, through custodial banks. Okay? So money funds instruct their custodial banks to make the transfer. This is the overnight RP take-up over time. We saw it already, so I don't need to spend much time about it. Volatile. It can be very material in size, from a few $100 billion up to more than $2 trillion if you extend this chart further at the end of 2022. It drains, it disappears as we drain liquidity from the system. So we have this object that is very material, this liability item, can be very material, as large as reserve balances basically, and fluctuates over time with the total amount of liquidity in the system. And money funds are by far the main users, more than 80%, 90% during periods of high usage. Okay, let's get to the results. So that was the institutional background. I told you, I apologize for making it so long, but it was kind of needed. So the first result is about the size of the MBFI sector that competes with banks in the deposit market when banks' balance sheet constraints go up, arguably because of QE. So the idea is that increased balance sheet cost give banks an incentive to shed deposits. These depositors will find their way into money market fund shares. We're going to use the end of the SLR relief as this permanent increase in banks' balance sheet cost as exogenous variation. And what's the identification strategy here? The idea is that the effect should be stronger for those money market funds that are affiliated with banks subject to the SLR. Why? It's pretty simple, because banks have an incentive to retain their customers within the same group. And from the customer's perspective, I have no switching cost basically. I have no switch cost. I just move my cash from the bank deposit into the money fund share affiliated with the same group. Before we get into regressions, I'm an empirical person. I believe in raw data. This is just raw cumulative flows in 2 groups of money funds over time from January 2020 until the end of 2021. Money funds affiliated with banks subject to the SLR and all the others. So standalone, affiliated with banks not subject to the SLR. The blue line is for those affiliated with SLR banks. And as you can see, around the end of the relief, their cumulative inflows started to increase. While for the other group, the cumulative flows were practically flat. The flows started to increase earlier in the first quarter of 2021 because the end of the relief was announced at the time of its introduction. So that's just data, of course, and so we have to do things a bit more formally. So we implement the same identification idea in a regression setting. It's going to be a panel regression at the daily frequency fund level. In a nutshell, on the left-hand side, you have daily flows in each fund. And the main objects of interest are going to be 2 interaction terms in which your treatment variable, the fund, the dummy, will be a dummy for whether the fund belongs to an SLR bank or not. And you have 2 time dummies, the quarter before, ahead of the end of the relief, and the quarter right after. You're going to have time-varying fund level control, so to have fund fixed effects and fixed effects. I'll briefly talk about identification. But the main result is in column 1. Basically, in the quarter ahead of the end of the relief, Funds affiliated with SLR banks experience additional inflows per day of 33 million, per day each fund. In the quarter following the end of the relief, the effect is positive but not significant, but it's still 22 million per day per fund. When you aggregate that, since these are just daily levels, daily values, and there are 100 funds affiliated with SLR banks, over 6 months, that's an additional inflow of $360 billion, which is not a small amount. Column 2, we tested the parallel trade assumption is satisfied. In column 3, we checked that it's not something that has to do with being affiliated to any bank. It really has to do with being affiliated with SLR banks. And then we repeated just looking at government funds, which is the largest segment of the industry, to make sure that it was not just a quirk of prime versus government funds. But identification, so how do we actually nail it, in my opinion? Well, we use, again, in institutional detail, a differential regulatory treatment of custodial banks. So custodial banks in our sample are SLR banks, so they're subject to the SLR, but they were already exempt from using reserves in the calculation of the SLR ratio in April 2020 in a permanent way, which means they were way less affected by the end of the SLR relief than other SLR banks. So what I should see that in funds affiliated with custodial banks, the effect is not there, or if it's there, it's very small. And all of the effect is actually in the SLR banks that are non-custodial. And that's exactly what we get with this test. So that's what this table is showing you. There's a second way to strengthen identification, and it's the intensive margin. They say we have data on the SLR of these banks. We know how close they were to their requirement, the minimum requirement. So I would expect that the incentive to push depositors away is going to be stronger for those banks that are closer to the requirement, which means that the inflows should be larger for those money funds affiliated with banks whose SLR is closer to the minimum requirement. And that's exactly what this regression does. You restrict the sample only to money funds affiliated with SLR banks. You use the intensive margin, and you show that for a 10 percentage point drop in the SLR buffer, affiliated money funds get an additional increase of $50 million in inflows per day. Okay? So very sizable. Now, let me move to the effect of balance sheet cost on fund portfolios. So the first part was on size. Balance sheet costs go up because we do QE, so they tighten. Banks have an incentive to push depositors, and this NBFI sector grows. What about its portfolio decisions? The idea, again, is simple, as I mentioned before. The idea is that if my balance sheet costs go up as a bank, I want to reduce all forms of debt. I'm going to push maybe depositors away, but certainly I'm going to reduce the amount of borrowing I do in the wholesale market, so less repo borrowing, for example. And that means that money funds now have to find an alternative. And ceteris paribus, they should tilt their portfolio towards the overnight RRP. So again, we're going to use the end of the SLR relief as this exogenous permanent increase in banks' balance sheet cost. And what's the identification strategy in this case? Well, in this case, it has to do with what you can do with your portfolio, right? So we're going to say that the effect should be stronger for government funds. Why? Well, very simply for two reasons. First, they have fewer investment options. They can either own all the government debt or repos backed by government debt. And secondly, in a more subtle way, because the increase in the balance sheet costs through the SLR for the banking industry is particularly costly when we think about repo intermediation. So doing a matchbook repo intermediation for our banks is going to be particularly costly under a tightening of this balance sheet cost, so a decrease in the SLR. And government funds can only lend to the private sector through repos. So they were particularly penalized. Okay, again, let's start with the data, just raw data. Here I'm showing you the percentage of fund portfolio invested over an RRP in two groups, government funds and prime funds, from January 2020 until the end of 2021. Blue line for government funds, red line for prime funds. So as you can see, basically until the end of the SLR relief, so the two vertical lines always represent the introduction and end of the SLR relief. So until the end of the SLR relief, the percentage of portfolio invested over an RRP is practically zero for both groups. Okay? However, after the end of the relief, the line for government funds started increasing much more rapidly than the line for prime funds. So the percentage of portfolio invested over an RRP seems to be much larger for government funds than for prime funds. Just data, of course, so let's do it in a regression setting. The idea is very simple. Again, you're going to have daily percentage of portfolio invested over an RRP in each fund, and you're going to regress it against the main variable of interest is going to be the interaction between your fund level treatment, so whether you're a government fund or not, and a time dummy, which is now is the dummy for after the SLR relief because I'm looking at a stock variable on the left. It's just share of assets you are holding in your portfolio invested at the central bank. We have to control for these month-end spikes that you all know about because the effect in relative terms in the portfolio may be different from primary government funds. And then we're going to have fund level time varying controls, fund fixed effects, time fixed effects. Long story short, after the end of the SLR relief, government funds increase their share of their portfolio invested with the central bank by 20 percentage points more than prime funds. The parallel trend assumption is not violated, so let's talk a bit about identification again. What we're going to do here in the first case is going to be, again, exploiting the intensive margin. Now we look just at government funds and we ask ourselves, okay, which of these guys are going to be more affected? As I said before, those guys that mainly rely on private repos to manage their cash in their portfolios. Because private repo intermediation was the one that was particularly penalized by the tightening of the SLR constraint. And that's exactly what column 3 in this regression is showing you. That the share within government funds, the share invested at the central bank increases relatively more for those guys that were relying more on private bank repo borrowing to manage their portfolio. Added 2 pieces of evidence to make sure that we're after the right thing. So repo rates declined right after the SLR relief, and they went up during the relief, which is telling you it's a demand shock in terms of borrowing, okay? It has nothing to do with the money fund size. It has all to do with the banking side of the story, because prices went up when balance sheet constraints were relaxed, so banks were willing to accept higher rates, but then they went down as soon as the balance sheet cost became tighter again. The other piece of evidence I find very convincing, again, uses an institutional knowledge, a bit of institutional knowledge. There are some repos that can be netted. So this is called the sponsor repo program in the US. These repos are nettable, which means that they take no balance sheet space, they're balance sheet neutral, so they were not really affected by the SLR relief or the end of the SLR relief. So we look at the portfolio of money funds, and we compare those repos that could be netted, so they were not really a cost for the banking system after the SLR relief ended, and all the others. And the nettable repos are flat, as you would expect. All the action is in those private repos that could not be netted by the banking system. So it's really about the banking system and tightening of balance sheet costs. Fantastic. Of course, there are other 2 things that everybody has in mind. Jeremy certainly had in mind yesterday when he talked about the treasury market disruptions. And these 2 things are the treasury market and interest rate risk. So why? So these 2 factors could confound our findings because of the following reasons. So when interest rate risk goes up, so you have these MBFIs, money market funds, they're issuing deposit-like claims on the liability side. In order to do that, you have to hold the debt, right? That's what they do. They hold debt contracts, which means that they're exposed to interest rate risk. When interest rate risk goes up, for example, if we start tightening and monetary policy stands very fast to fight inflation, as it happened around the time a bit later, well, they have a duration risk they have to manage, so they want to shorten the duration of their portfolio. So ceteris paribus, they're going to go to any overnight investment, including the overnight RP. So you should expect larger overnight RP investment in the face of higher interest rate risk. T-bill supply goes a bit the same way. These guys are offering these money-like assets, these money-like claims on the liability side. They're for sure going to invest in government bonds. If the supply of these government securities goes down, they have to find something else. Ceteris paribus, they're going to park more of their portfolio at the overnight RP. Why does it matter for our identification? Because both effects are going to be stronger for government funds. For the same reasons I gave you before, because they have fewer investment options. These are the only things they can do. So we re-estimate everything, including, of course, the interactions of these exogenous external time-varying factors with our treatment dummy at the fund level, so with a government fund dummy, and our results remain valid, they hold. Of course, we also find that both government bond supply and interest rate risk, which is captured here by the MOVE index, are important determinants of overnight RP. But they do not explain away the importance of banks' balance sheet cost. The final thing, and then I want to conclude, we re-estimate everything. So far I showed you the portfolio in percentage terms, right? The portfolio composition. A question for us, and in general for monetary policy implementation is, well, what about dollar terms? If I put everything together, what's going to happen? So we re-estimate our regression setting, looking at dollar investment at this deposit-like facility for MBFIs, for money funds, for net RP, putting together all the pieces. So the piece that has to do with the growth of the industry, so whether funds are affiliated with SLR Bank, the piece that has to do with whether you're a government fund or not, plus interest rate risk and government bond supply. And what we obtain is that the effect of balance sheet cost, banks' balance sheet cost, on the dollar investment of money funds at the overnight RP is very material. So after the end of the relief, funds affiliated with SLR Bank invested $1.2 billion daily per fund more. and government funds, $7.8 billion. Okay? So the effects are very material and they explain a lot of the take-up. Okay, so here are the conclusions. Higher banks' balance sheet costs caused by large QE injections. Well, they have two effects on BFIs competing in the deposit market. They're going to make that industry bigger in size because investors are going to move from deposits into money fund shares. And they are going to tilt the portfolio of these NBFIs to the central bank if they have access to the central bank. So QE and QT interact with bank regulation, affecting the size and portfolio of NBFIs. And I want to leave you with a question. So basically, going back to Yiming's paper, right? She shows that when you do QE, then you may crowd out bank lending, right? Because of a tightening of balance sheet cost. But now if NBFIs have access to the central bank balance sheet, and these NBFIs are competing in the deposit market, well, banks can actually drain reserves because they can use the overnight RP, if you want, as a safety valve, push depositors away. These depositors will go into money funds, they're going to get bigger. Banks are going to borrow less from money funds, and money funds will have nothing to do than just parking their cash at the overnight RP or whatever deposit facility, draining reserves from the system. So does it improve or deteriorate QE and the effectiveness of monetary policy transmission? We don't know, but I think it's an important question. Thank you.
So then Yiming Ma for the discussion.
That's great.
All right. Hi, everyone. It's really always a pleasure to be at the ECB, to see many friends, new and old. It's also a great pleasure to read and learn from Gabriella's paper, from whom's papers I have really learned a lot over the years. So these are just my thoughts on the paper, but let me motivate maybe just the setting, just to show how important this question really is. I guess for this audience, this is pretty clear. There's really a lot of reserves in the system. This is true in the US. Reserve balances have exceeded 4 trillion once upon a time. They've come down a little bit, but as we heard from Jay Powell, they're going to restart again the increase of reserve balances. So it's definitely something that is here to stay. The US is not alone. The Euro system has even more in total size of the central bank's balance sheet. And so this is a phenomenon that is really common across jurisdictions. So given that, it's of course very important to understand the implications of this large central bank balance sheet. And there's been a lot of work on that. I think the first set of papers on QE have focused on the asset purchases. And maybe many of you in the room have contributed to that understanding. But I think more and more, I think there's a second set of literature that is trying to understand what is the impact of reserve injections in the system. Okay. And so reserves are a special asset because they're very liquid, but they can only be held in the banking system. Right? And so what that means is that if you have one additional unit of reserves, then that is something that has to show up on the asset side of bank's balance sheet. And as Gabriella so kindly mentioned, we have some work on that, meaning that if these reserves take up balance sheet space, and if balance sheet space is costly, then maybe banks can do less of the other things they could have done with their balance sheets, including lending. Now, there's another side of bank's balance sheet, of course, and that is the liability side. And what happens to the liability side depends on who was selling these treasuries or mortgage-backed securities to the central bank during QE in the first place. In the US setting, a lot of the treasuries that were sold were not originally held on banks' balance sheets. So think there's a hedge fund or an asset manager who wants to sell the treasury to the Fed, but the hedge fund doesn't really have an account at the Fed directly. So the Fed is getting a deposit at the bank, and the bank is getting a reserve from the Fed. And what that means is that this increase in QE would expand reserves and at the same time expand deposits. I believe that channel is relatively weaker in the euro area. If banks are holding more of the securities that were sold in the asset purchases, then that means the expansion of deposits is relatively less. right? But nevertheless, there is some degree to which banks' liabilities are expanding. And Jeremy yesterday alluded to this, and there's some discussion about what does that do to the liquidity demand of the banking system. Does it increase, does it decrease liquidity demand? With some co-authors, also Christian from the New York Fed, we have some work on this recently, thinking that, well, maybe the people who are coming in as depositors doing QE are not really the same depositors that have always been in the bank, right? So if people who were originally holding onto securities, these are institutional depositors, these are probably much flightier depositors than your mom and pop investors who were always in the bank. So if that is the new influx of deposits, maybe the resulting deposit base is changed in composition, is changed in degree of flightiness. Right? But that all is to say that this is a literature about how the banking system is affected by reserve injections. And I think Gabriella's paper is very important because I think it also sheds light on the fact that it's not just banks that are structurally changed. It's also non-banks that we want to think about, because non-banks and banks, they are interacting in many important ways. Right? So I see this paper as a very important contribution in helping us understand what is the impact of non-banks when banks are getting a large supply of reserves and when these reserves are counted in leverage requirement, in particular in the supplementary leverage ratio. Right? So that's why I think it's a really important paper. And as Gabriella already very nicely explained, there are two main results. The first one is if banks have a lot of reserves, these reserves are costly to hold, they're going to want to shrink their size of the balance sheet. One way to do that is to cut deposits by offering lower deposit rates, for example, and deposits and money market fund shares are substitutes, so that's going to shift funding to money market funds. Banks can also reduce their balance sheet size through reducing the amount of wholesale borrowing they take up. In the US, one major form of that is the tri-party repo that they are borrowing from money market funds. And if they're borrowing less from money market funds, then that is shifting money market funds' investment opportunity set. And if money market funds now can lend less to the banks, maybe they're going to lend more to the Fed through the overnight RRP facility, which is essentially the Fed is borrowing repos from the money market funds. Okay, so these are the two main results, and I think they're very convincing. The identification, I think, is very clean. So I definitely recommend all of you to read, I think, this important paper. I really don't have anything to quibble about the execution. I think I just wanted to talk about maybe two main thoughts. Usually I have 3 points in my discussion. This time I really couldn't think of a third one, so just two thoughts on the big picture takeaway of the results. Right? So the first one is about how to think about the role of QE versus the balance sheet costs of reserves, right? So the paper essentially is comparing, the effect from banks who are subject to the SRR and those that are not, right? Meaning that to have an effect in the results, you both have to have a large amount of reserves, and these reserves have to be counted in the leverage ratio requirements, right? So I think it will be interesting then to understand, well, how much of what we see in the paper is due to the fact that there are large reserves outstanding, and how much is due to the fact that reserves are costly to hold because of regulatory requirements, right? Because even without regulatory requirements, the bank is doing a portfolio choice where it probably doesn't want to invest everything in reserves. So I think it may be, helpful to shed light on the magnitudes of, which of these two channels is contributing how much, right? So what I mean is, on the asset side, again, you think of QE as an injection of liquidity, an injection of reserves. Even without any balance sheet costs, banks may not want to just hold all reserves and become a narrow bank. So they're going to choose optimally, how to adjust their balance sheets and how much of other assets they're going to hold. Now, that marginal cost, marginal revenue consideration is going to be tilted by regulatory costs, because if you put an additional tax on holding reserves, then banks are going to want to hold fewer in these reserves. And more of the liquidity, you can think, is going to shift it onto money markets funds balance sheets in the form of overnight RRP take-up, right? So in that sense, I think it's helpful to understand how much is this just because there's a lot of reserves, right? And in the figure that you see here, you see the top line, the blue line is the total amount of reserves outstanding, and then the bottom line, the dotted one, is the uptake in the overnight RRP. You can see that they're very positively correlated, right? So how much of this is just because, if you inject a lot of liquidity, the liquidity wants to go and be equivalized across different sectors, and how much of this is because, well, the sector that you're injecting the liquidity into, which is the banking system, is very constrained by the leverage requirements, right? So I think it would be nice to maybe have a breakdown of magnitudes. This is for the asset side. I think this also holds for the liability side. Again, there is this substitution between bank deposits and money market fund shares. And here you want to think that, again, if there's just QE without any regulatory requirements, banks probably also don't want to just keep a very large balance sheet if their investment opportunities are not getting a high enough return, right? Maybe they want to shed some deposits already, right? But now, if you further impose a cost in terms of regulatory leverage ratio on holding a large balance sheet, maybe they want to get rid of even more deposits, right? And so you see that in the bottom picture, which plots the growth in commercial banks' deposits and money market fund shares, you see that in the two QE episodes over here and over here, there's positive correlation. But you also see negative correlation in other periods of time, which exactly is because of the substitutability between money market fund shares and deposits, right? So here, I think it would be nice to understand, to what extent do reserves push money into money market fund shares, and to what extent does the leverage ratio requirement tilt the amount of deposits that have been pushed into the money market fund system, right? I think the results are all there, but it would be nice, I think, to flesh out those magnitudes. Right, so that's the point one. And then point two is maybe about the implication. So I think Gabriela mentioned the first implication that was mentioned in the paper. I think the other one that was talked about is how, because of this movement between reserves, and you can think the overnight RRP facility, the Federal Reserve's ability to efficiently expand and contract the balance sheet may become more limited. So I agree on face value, that is definitely true. I think if you look at how, the infrastructure works, but I think maybe it's good to think about whether the goal of monetary policy should be to exactly control the volume of reserves, and what, the goal of having the overnight RRP was in the first place. Right. So the overnight RRP was first introduced when the US first came out of low interest rate environments, because the worry is that as the policy rates were lifted, that banks would not pass on these rates to money market funds, right? There's lots of frictions in repo markets. Banks have a lot of bargaining power. So, what if the policy rates get raised, banks get raised their rates, but then they don't pass it on? And so the overnight RRP essentially was to tell the money market funds to say, hey, if the banks are not giving you that higher rate, the Fed is going to give you a higher rate. You can directly deposit secured with the Fed, and that also provides an outside option for money market funds to which they can use when bargaining with their banking system. And it worked very well. Rates were lifted. The money market fund overnight rate provided a floor on the system. And so you can think that this provision of the overnight RRP facility, or to have some liquidity supply to the money market fund sector, was to allow the funding rates to be equivalized across the banking system and an important non-bank market, right? And for the price to be equivalized, you exactly need the volumes between the reserves and the overnight RRP to move, right? That was the whole idea, because if you don't have the volume in the overnight RRP and you just have, reserves in banks, it's segmented, it's locked up, it doesn't necessarily mean that the costs will be spread to other sectors, especially if the banking sector is constrained and has bargaining power. Okay, so I think the goal is perhaps at the beginning not to equivalize volumes or to say who has how much in amount, is to exactly let the market determine who has what amount, so that the funding rates across important funding markets can be equivalized. Right? So under that backdrop, I would actually not change anything to the results. I think the results are perfectly fine, but perhaps the takeaway is not that, you know, the overnight RRP or these balance sheet costs makes it difficult for the Fed to control the amount of reserve balances. Maybe we can think of this as that when we decide the amount of reserves or the amount of QE, it is important to consider who has access to the central bank's balance sheet. Right, and I think we've heard this potential trade-off here. Originally I thought I think, but now I think this was now mentioned multiple times. So I'm more confident in that opinion. I think there's a bit of a trade-off. You can have a smaller balance sheet and more limited access, but then you're more directly targeting a subset of the economy, which is the banking system, and you're relying on those institutions to transmit the rates across. Of course, this works sometimes and may not in other times. So the other way is to do a broader access. So more total supply, but also more direct control on rates. And so there's the larger supply of this broadly defined central bank money. Right? And I think this paper has highlighted, I think, one step of that. Broadly speaking, you can go from bank reserves to bank reserves as the overnight RRP, but I think this is a more broader question because you can also then think ultimately, you have access, to stable coins that are now maybe getting a skinny master account at the Fed, and eventually to even more access by other institutions and maybe even retail, and that will be CBDC, right? So I think this is a kind of trade-off that the RRP has started to illustrate, but I think it's something that is here to stay and that is important to consider. There's one important caveat, and this is definitely last but not least. An important caveat is that the RRP is a safe storage facility. It does not allow these overnight RRP balances to be used as a means of payment. And that is very different from when we think about CBDC and even stablecoin master accounts. And so I think maybe a more refined version of that first line of the interpretation should be that when we decide the amount of reserves to inject in the banking system, we should think about who else has access and who else has access with what kind of functionalities, because both are going to affect how much optimally the banks should be holding, right? So that's all I had. Again, I think important paper to think about the implications of reserve injections, not just on banks, but also on non-banks. And the suggestion is just to think about the effect of QE versus balance sheet cost, how much they each contribute, and also the takeaway, which I think is a very big and broad one, which is we want to think about the system jointly in terms of banks and non-banks, and how much the banks should be getting should depend on who else gets how much of what. Thank you.
So, Gabriele,
And
would
2
you
minutes
like?
just
Yeah,
to,
absolutely.
so first of all, Yiming, thanks a lot for the amazing discussion. Fantastic as always. 2 points, right? So I want to touch upon both the level effect, right? The macro effect. So as some of my co-authors know very well, identifying micro things is much easier than identifying macro effects.
I agree.
And so we thought about it. The truth is that we haven't done it, of course, and we will try. I totally agree. That's the first order importance because we just very narrowly, I told you it's an identification paper. We think identification is robust, is solid, but then the issue is how much of an first order quantitative effect you guys have. So we will try to do it because actually by just seeing the charts you put together, maybe a simple decomposition exercise is feasible without requiring too much effort. Doing it super carefully, honestly, I don't know how easy that is.
No, I agree.
I think it's going to be hard. But point taken, I think that's first order importance. Regarding whether the NRP helps or does not help monetary policy transmission, so the quote that you have from the paper originates from when we started writing the paper, right? It was back in 2022, so a few years ago, and overnight RP was still very, very large. And we were trying to understand why is it so large, so that's how we came to write this paper. And back then, the concern was, okay, this thing is so large, is it going to shrink to zero when we start draining liquidity from the system, as it should, and as it did back then in 2017, but in 2016, didn't reach $2.5 trillion, right? So that was the concern. So that's where that sentence is coming from, right? Say, oh, can it create a problem? Okay, because maybe it constrains our ability to drain reserves from the system. The truth is that I personally, my own personal views, do not necessarily reflect the views of the Federal Reserve System, New York Fed, or not, is that actually it helps. It helps because it kind of goes to ameliorate the issue that you identify in your paper, the fact that QE can tighten banks' balance sheet cost and then can crowd out bank lending or other activities. By providing banks with this safety valve, you're actually kind of making their lives easier, right? Because they say, look, you don't really want deposits, you don't really want to borrow wholesale. All these safe reserves are taking this space in a useless way on your balance sheet. Push it out. Someone else will take that liquidity, park it, and drain reserves from the system. So my personal view intuitively is that it's going to help the transmission of monetary policy. That's just my personal view. And on the last comment, yeah, I agree. Two views. You could have probably a linear balance sheet with access only to traditional banks, or you can have a broader, larger, maybe balance sheet with MBFIs too. It's not super clear to me that the first one is necessarily smaller, right? At the end of the day, you still need to provide the banks enough liquidity so that money market rates in which they operate do not spike. So intuitively, yes, but you know, I'm not sure. I'm not sure how much of this is driven by the US experience, which we really went big to fight COVID, and we ended up spending a long time deep in the Bonton region. I don't know whether that's necessary as an optimum in the steady state. Do you know what I'm saying? But it's just my 2 cents.
Super, thank you.
One,
Yeah,
two,
let's
three,
take
four,
questions. Let's start here in the second row.
Hi, Antonio Garcia from Santander Bank. Congratulations, a super interesting paper and also a very illuminating discussion. I learned a lot from both. Just a question perhaps on the policy implication side. You kind of left us with a cliffhanger, but now you gave us a little bit more juice on it, which is it is very interesting. So, look, it is very interesting the part in which how regulation interacts, the access or not of MBFIs to central bank, and that driving your results in terms of the size of MBFIs, the MMFs in this case, and then the change in the asset composition of them. But if we move forward to current situations relative to the natural experiment that you conducted, we are now in this situation in which there's more what we call regulatory simplification in banks, so maybe deregulation. Then there's also obviously an increase in the supply of US treasuries, short term as well. And there's also perhaps, well, if we measure interest rate risk by interest rate volatility, there's way less. So all these issues that you address in the natural experiment is kind of the reverse of it, or the opposite of it. So I want you to, if you can comment a little bit sort of on the policy implications and the current circumstances, whether you actually need even more access to the central bank by MBFIs, not just to the liability, but to the asset side, okay? Whether there's merits into access by some, not all, some MBFIs, maybe UK style, for some institutions to mitigate financial stability issues, so your monetary policy works better and is better transmitted. Are there merits into that, or does your paper speak to this?
So there are 2 parts in this question, the way I say it. The first part is whether what we show in the paper is consistent with the current conditions, and I would say yes. What we identified back then is basically consistent with what you observe now. The NRP disappeared, and it is true that now the treasury supply went up, interest rate risk went down, so all the things that push money funds to invest in the NRP kind of disappeared, and SLR constraint is not probably as binding as before because we've been draining reserves from the system. So that's the first part, which is more of a statement. Yes, so it is consistent, what we observe now with what we identify in the paper, which to me is very reassuring. Now let's come to the tricky part, which is the sort of policy question. Personal views, again, totally personal views. I think that the NRP helps the transmission of monetary policy and the management of our balance sheet because we are in a very specific money market, which is different from the European one, in which money funds are very large. So in the US, money funds are key. So you want to accommodate for that. Now, asset side, I do think that facilities open to non-banks that are key and target really some important money markets that we care about, those are useful. So SRF, I think it's very useful. And I think the example what they did at the BOE was also very useful. So personally, I'm not against it. I think it's very natural. Of course, you have to set some boundaries. Then my boundaries would be what are the markets I really care about as a policymaker in a monetary authority. It's not going to be every market in the world because that's not monetary authority. So those 2-3 markets that I really care about, I want to target specific institutions. Doesn't matter whether they are banks or something else. That's my view. There is a man. There is 3, 4. Where do we go?
Okay, Imen as the host. There's a microphone.
Sorry, I'm using my host capacity. But just to say, Gabriele, I really liked the paper. I think that using this natural experiment of the SLR relaxation during COVID is an excellent way to quantify the impact of regulatory costs to intermediation, and also how this shifts the equilibrium between banks and non-banks in the financial system. So in Europe, we also had a temporary exemption of the SLR during COVID, but we're probably unlikely now to relax the leverage ratio requirements. I wanted to highlight, and there I also invite some of the senior central bankers we have in this room from other jurisdictions that have deep experience of both banking supervision and markets that may want to come in. So Vicky, Makoto, and others. That also shows the link between regulation and market functioning. Okay, and then I have two pointed questions. The first one is, are you able with your model to quantify the difference of impact between the exemption of central bank reserves and the exemption of government bonds from the SLR? And then what about the NSFR? Because in the Basel rule, there was a weight on repos against government bonds on the NSFR. In Europe, we actually, you have a permanent exemption from this in the US now, and there are also permanent exemptions in other jurisdictions. In Europe, we had a temporary exemption that was actually falling in June of this year, yeah. And we did really a lot of work with my teams and also with banking supervision to kind of look at, should we prolong or not? We finally decided to prolong, but if there's any result about whether we did the right thing, that's interesting. Thanks.
Okay, so brilliant idea. We didn't think about it. I think it's feasible. And I'm referring to the idea of looking at trying to understand whether exempting reserves rather than treasuries is going to have a differential effect. It's not straightforward, but there could be ways to do it. But just looking at the balance sheet of these banks and see whether they have relatively more one than the other, and then corresponding to that, you look at their both deposit activity, affiliated money fund flows, and borrowing in the wholesale market. So you can basically repeat it, having some proxy for exposure, and you see whether it was more important for banks that were holding lots of treasuries rather than reserves. It wouldn't be clean, but we can try. So we haven't done it, but it's something that we could try and do. Now, regarding the NSFR, right? Yeah, net stable funding ratio. I don't know much about it, so I'm not an expert. What my experience from writing this paper and thinking about these problems is that this exemption was very useful. And so prolonging exemptions similar to this in spirit may not be a bad idea. And the reason why I think it was useful, and I think similar to that in spirit, the qualification means, personally, including reserves in the leverage ratio, to me, does not make much sense. That's my own personal views. Totally personal. So to the extent that the exemption in the NSFR is sort of similar or speaks to the same tweaking of an important regulatory constraint that I understand where it's coming from, things can be improved, right? So if it improves it, improves it.
Great, thank you very much. We have run out of time. I'm really sorry to... Okay, you're the host, and you mentioned Vicky, but all the other discussions, I'm sorry, then later on. Vicky, you go on.
I'm sorry to prolong this. It's just in responding to our kind hostess's very good question. I also really like the paper, and the discussion was brilliant as well. So thank you for that. It is tricky, actually, this interaction between regulation and QE, QT, QN, and the interactions with the central bank trying to maintain monetary control and transmission. Because, of course, there are objectives of the leverage ratio itself. And the objective was, it's non-risk weighted, as you correctly said, but risk weights are not perfect. Indeed, we have lots of examples of risk weights failing. And therefore, the leverage ratio was set by regulators in order to have a backstop, quote unquote, that word again, against the failures of risk weights for resilience reasons. Now, we at the Bank of England have exempted reserves from our leverage ratio. And that was done at the time that we did one of our QEs, or asset purchases, in order not to have some of the effects that you described in terms of balance sheet costs. But, I mean, we need to think, however, also what the impact of this has. I mean, obviously it increases the demand for reserves, and it decreases the balance sheet costs, other factors being equal. But also, without also exempting Treasury securities from the leverage ratio, it creates an asymmetric incentive in terms of banks extending repo generally to other banks, and particularly to non-banks in the world that repo. So there is another consequence of that. So you effectively need a general equilibrium way to try to understand all of this. And on the fact, which goes back to the debate, if I may, given that I have the floor, that we had about Friedman rule and so on, coming back to Isabel's speech, but also it has come up in other contexts, and also the papers by Vissing Jorgensen, which came up in Franklin's paper. I mean, reserves, are they totally costless? I mean, to supply them, you either need the central bank to take on government bond, so interest rate risk, or the central bank, or the central bank to lend to financial institutions through repo, and therefore take on some credit risk. So you need to think, and by doing so, the central bank takes out certain assets, because the central bank will always lend in a collateralized way, that also have a convenience yield. Mm-hmm. So the Friedman rule needs to be extended for that. And that is also relevant to this debate that reserves are completely costless. Thank you.
So, super briefly or not? Okay, super briefly. The first part, totally agree with you. My statement was a partial equilibrium statement. I didn't even mention anything about treasuries. I just said reserves should not be there. I didn't say whether I think treasuries should be there or not. The reason why I didn't say it is because it's trickier. Because reserves is just money. It's literally liquidity. Treasuries, they are very safe. People keep saying that they're super safe, but sometimes they're not. And the prices fluctuate. So I can't put them on the same footing in terms of leverage ratio rationale. Of course, if you want to make an optimality statement, it would be ideal to have a GE model in which you take into account the interplay that reserves and treasuries have in money markets more generally, not just from the perspective of being a leverage ratio measure. So I totally agree with you on that. For what concerns Friedman rule, and whether providing reserves is costly or not, again, I agree with you. So Friedman rule is optimal in all these models in which you have no frictions. As soon as you start having frictions, Friedman rule is not optimal anymore. So let's start from that. So it may not be optimal even now. My perspective is that, so we have this paper with John on the optimal supply and all this theory paper. In a sense there we are a bit agnostic, and the idea is that different jurisdictions may have different considerations. Some people care about political economy, independence, excessive footprint. This will position your target somewhere along the curve, which is not necessarily the flat part. And then the question, I think, is each jurisdiction should have its own pseudo-Friedman rule. And then the framework will be what's the optimal amount of reserves and corridor between deposit and lending facility that allows you to achieve the target. So yes, Friedman rule is not optimal in the real world in a sense, no? Almost by definition.
Great. So thank you very much for this lively discussion. I hoped for it, and there we had it. Let's continue in the coffee break. Thank you all.